Today, I want to talk about kind of the intersection of three topics, which is property tax, multifamily in Texas, and accrual accounting. I guess three of the nerdiest topics out there.
I'm a nerd.
Okay. Hi, my name is Perry Zhang. I'm the founder and CEO of Pallas. Pallas is a Y Combinator-backed technology startup that helps you invest in real estate syndications passively. It's kind of like Facebook Marketplace for real estate investing. Now, the problem statement is, as a LP on real estate syndications, you often get shocked by the increase of property tax, and that general partners, as a result, tend to stop distributions because they don't know what to do with that increase of property tax. And they also don't communicate it in a way that kind of quote unquote makes sense. So I will kind of go down the facts, and then we will explain what makes it so complicated. The way it works in Texas, multifamily in Texas, is in May of every year, the county sends a bill to the multifamily operator, say this is the amount of taxes that you need to pay. To give you a real example, it may come out to be $65,000 per month that they need to accrue in terms of the expenses for property tax. Now you're like, $65,000 is $780,000 a year, right, in property tax. Now you may be like, wow, what kind of property has $780,000 in Texas? It's expensive, probably like $30-40 million property.
That's expensive.
Now that $65,000 per month in property tax is actually dated retroactively to January of that same year. So if you get the bill in May and for 2023, that actually applies all the way back to January of 2023. But up to that point, here's the rub. General partner only accounts for, say, $50,000 per month in property tax. So there is a delta of $15,000. Okay, so get to the second point. The bill that the county sends to the multifamily is never the final bill. It is usually the heights. It's a negotiation between the county and the multifamily with that apartment complex. So right now it's $65,000, but $65,000 per month is not the final bill. So what the operator or the general partner does is to protest against it. So they will work with a tax consultant to protest it with the appraisal board review. And the appraisal board review will hear the case, go to a court to hear the case through email and through and they will give you a review on July of that same year. So in this case, July of 2023. And the bill, the result of that might be $61,000 per month instead of $65,000 per month. So like a $4,000 reduction. But that's also not the final one. So when the operator is not satisfied with that number, they will further protest it by quote unquote suing the county. And that's also working with a tax accountant. And that hearing process will take longer. That's also asynchronous, or maybe that is synchronous. I actually don't know. I think the tax accountant actually needs to go to the court to present their case. On January of the following year, in this case, hypothetically, January of 2024, if you haven't heard back, if the operator hasn't heard back from the court, then they will pay whatever the appraisal board review gives them as that temporary tax bill, right? In our example, it's $61,000 per month times 12, so whatever that number is. And then around March of the following year, which is in this case 2024, the court could come back with a finalized number, and that's usually lower than what you paid already. So you get a refund of between $61,000, and so that usually comes out. Hypothetically, in this case, it comes out to be $58,000 per month. So that's $3,000 difference times 12. So you get $36,000 back for that year. And that's basically, that wraps up by March of the following year. It wraps up the entire tax situation, the property tax situation for that multifamily, right? Because that is the full conclusion. If you were to do it the right way, you basically will accrue $58,000 for all of 2023. You see what I'm saying? So that makes sense. Now, what are the complications? The complication is you wouldn't know that it's $58,000 per month until you get that first bill, right? Without that first bill, the general partner has no anchor point of what is the property tax for that year. So it's almost premature to assign some arbitrary number on January of 2023. So that's why they don't do it. And then secondly, which is actually the more complex part, which is general partner has been budgeting $50,000 per month for 5 months when they get the first tax bill, and they realize that it's probably going to be $58,000 for the entire year. So then there exists a number such that they need to budget, or aka accrue, between June to December. June to December is actually 7 months inclusive, and such that it averages to be $58,000 of the property tax for the entire year. So you do some math, which is 50,000 times 5, which is 5 months already, plus 7 more months times the accrual number X equal, the whole thing divided by 12 is equal to $58,000. And solving for X gives you about $64,000 that you need to accrue starting in June. That's the math. But like, what does that actually mean? That means distributions will come down. Yeah, that's what it means. But the general partner just feels like this is like really complicated. This is like very hard to explain to the LPs. And so in their monthly update, they usually don't say any of that. They're just like, oh yeah, we are hit with the property tax, and as a result, our distributions will be paused. And so this is why this is important. Now the LP, upon hearing this, like if you don't understand this, then the LP will be like, I thought it's doing so well, and now we don't have any distributions. And then the next year, whoa, there is a refund of tax. Like, it's such a roller coaster of emotions, right? Awesome. And then, we suck. And then, oh, wow, we got a refund. I think the more that investors or LPs understand kind of how it works, the more they will understand, oh, this is just how it works. It's only affecting the first year of operation, because the second year, if you get that refund, the general partner is basically putting that to budget for the first 5 months, and such that they don't have to budget too much extra for the last 7 months. So, but the first year, it's kind of like the most dramatic. I like to say that if you don't know how you make money, you also don't know how you lose money. And so in this case, it's useful to know that that's just how it works. And don't be alarmed and surprised. Oh wow, this the property was doing so well, and then the operator kind of don't do well. Here's a very fair point, which is the operator kind of know this is coming. They either don't want to communicate it, or that they know that this is a temporary first year problem, or that they feel it's too complex to communicate to the LPs. And there's nothing wrong with the general partner, feeling like, oh, this is like not necessary for the LPs to know. And even if they explain it, the LPs will ask like 10,000 other questions. So that's why they don't do it.
Why don't you stop asking questions you know the answers to?
And so it all makes sense that this is not commonly, communicated to the LPs. And so if you have more questions about how this works, feel free to comment on the link below. Or you can head over to Pallas and hang out with other Pallas LPs that invest in syndications, and to get their recommendations on what GPs they refer. With that being said, thank you for watching this video, and happy investing. Bye-bye.